What if I told you that in 2026, your paycheck could look very different, even if your salary stays exactly the same? It sounds a bit like a riddle, doesn't it? But this isn't a trick question. A massive shift is coming to the US tax code, and it's set to affect millions of Americans, from single filers to large families. Are you prepared for what's on the horizon? Stick with me, because over the next few minutes, we're going to break down exactly what's happening, why it matters to your wallet, and what you can do to get ahead of the curve. This is the financial heads-up you can't afford to miss. So what's all the fuss about? It all goes back to a piece of legislation you've probably heard of. The Tax Cuts and Jobs Act, or TCJA, which was signed into law back in 2017. This act made some of the most significant changes to the US tax code in decades. It lowered tax rates for many individuals and corporations, nearly doubled the standard deduction, and made a host of other adjustments. The thing is, many of these changes for individual taxpayers were never meant to be permanent. They were written with a built-in expiration date, the end of 2025. That means, unless Congress steps in to pass new legislation on January 1st, 2026, the tax rules will snap back to what they were before the TCJA. It's like a financial time machine, and it's crucial to understand where it's taking us. All right, let's get into the nitty-gritty, starting with the most direct impact on your take-home pay: the tax brackets. Under the TCJA, most of the income tax rates were lowered. For example, the 15% bracket became 12%, the 25% bracket became 22%, the 28% became 24%, and so on. The top rate also dropped from 39.6% to 37%. In 2026, these rates are scheduled to revert to their higher pre-TCJA levels. So that 12% rate goes back up to 15%. The 22% rate jumps back to 25%. The 24% rate returns to 28%. You get the idea. It's not just the percentages that are changing. The income thresholds for each bracket are also adjusted. Let's make this real with an example. Imagine you're a single filer with a taxable income of $90,000. In 2025, under the TCJA rates, a large portion of your income is taxed at 12% and 22%. But in 2026, those same dollars will be taxed at the higher rates of 15% and 25%. This means, all else being equal, you'll owe more in taxes. Now let's consider a married couple filing jointly with a taxable income of $180,000. They will experience a similar jump. The income that was comfortably in the 22% bracket will suddenly find itself in the 25% bracket. This ripple effect moves all the way up the income ladder. For higher earners, the top marginal tax rate climbing back to 39.6% from 37% is a significant increase. No matter where you fall on the income spectrum, this reversion means you're likely to see a higher tax bill, unless you plan accordingly. It's a fundamental shift in how much of your earned money you get to keep. Next up is another huge change that will affect nearly every single taxpayer: the standard deduction. One of the signature features of the TCJA was that it nearly doubled the standard deduction. For 2024, it's $14,600 for single filers and $29,200 for married couples filing jointly. This was a massive simplification for millions of people, as it made itemizing deductions less beneficial. Many people who used to track mortgage interest, state and local taxes, and charitable donations found it was easier and more financially sound to just take the higher standard deduction. Well, get ready for a big reversal. In 2026, the standard deduction is set to be cut roughly in half, returning to its pre-TCJA level, adjusted for inflation. We're talking about it dropping back to something around $7,000 to $8,000 for single filers and $14,000 to $16,000 for married couples. This is a game changer. Why? Because with a much lower standard deduction, itemizing your deductions suddenly becomes a much more attractive and even necessary strategy for many people again. But wait, there's a flip side to this coin. As the standard deduction shrinks, something else is making a comeback: the personal exemption. The TCJA eliminated personal exemptions, which used to let you deduct a certain amount for yourself, your spouse, and each of your dependents. In 2026, they're scheduled to return. This is especially important for families with multiple children. Each dependent will once again provide a significant deduction, which could help offset the pain of the lower standard deduction and higher tax rates. So, while single filers and couples without kids might feel the sting of the lower standard deduction more acutely, larger families might find that the return of personal exemptions helps to soften the blow. It's a complex dance between these different moving parts. Now, let's talk about your future specifically, your retirement and investment accounts. These tax law changes don't just affect your yearly tax return. They have long-term implications for your wealth-building strategy. A key area to watch is your retirement savings, especially if you're a fan of Roth accounts, like a Roth IRA or Roth 401k. Roth contributions are made with after-tax dollars, meaning you pay the tax now, and your qualified withdrawals in retirement are tax-free. With tax rates set to go up in 2026, the math starts to look a bit different. Think about it. Does it make more sense to pay taxes now at today's lower rates or later at potentially higher rates? For many people, the answer might be to pay the tax man now. Beyond the big ticket items, there are several other key changes to be aware of. For instance, the cap on the state and local tax deduction, known as the SALT deduction, is set to expire. The TCJA capped this deduction at $10,000 per household. For people living in high-tax states like California, New York, or New Jersey, this was a major blow. In 2026, that cap disappears, which could provide significant relief for homeowners in those states. Another important one is the child tax credit. The TCJA expanded it, but it's set to revert to its old form, which is less generous and has different eligibility rules. So, what can you do to prepare? First, accelerate your income if you can. If you have the flexibility, try to realize more income in 2024 and 2025 while rates are lower. This could mean selling appreciated stocks or taking a bonus early. Second, consider those Roth conversions we just talked about. Paying the tax now at a lower rate is a classic tax planning strategy. Third, if you're a business owner, look at your expenses. It might make sense to defer deductions until 2026 or later, when they'll be more valuable in offsetting income tax at a higher rate. And finally, start thinking like an itemizer again. Begin tracking those potential deductions, mortgage interest, property taxes, charitable gifts, so you're ready if itemizing becomes your best option in 2026. Let's do a quick recap. The sun is setting on the Tax Cuts and Jobs Act. In 2026, we're expecting a return to higher income tax rates, a much lower standard deduction, and the comeback of personal exemptions. The SALT deduction cap is going away, and the child tax credit is changing. This isn't just a minor tweak. It's a fundamental overhaul of the tax landscape that will impact your financial planning for years to come. From your paycheck to your retirement strategy, everything is connected. By understanding these changes now, you can start making smart moves to position yourself for success. The key is to be proactive, not reactive. The financial world can be complex, and these changes are a perfect example of why staying informed is so important. Of course, everyone's situation is unique, so I always recommend speaking with a qualified financial advisor or tax professional to tailor a plan that's right for you. They can help you navigate the specifics and make the best decisions for your financial future. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more deep dives into the financial topics that matter most. Stay informed, stay prepared, and I'll see you in the next video.